What's up? Wagwan, big up on yourself. It's your boy Illuminati, linking up for Crypto Caribbean TV and Crypto Today. In this day of our Lord Satoshi, February 3rd, April 2023. If you know, you know. Today, guys, I wanted to talk a little bit about something I promised you all: fractional reserve banking. And that basically is the banking system where banks keep only a portion of their customers' deposits in their reserves, which means basically cash or other high liquidity assets. And basically they use the balance for loans as well as investments. But before we get into that, new day but same stay. Nothing that I share in this video or any other is financial advice. Me not no financial advisor. I drink cognac on the rocks, so I obey the ICE rule. Information, conversation, education. Yeah? So let's get straight into it. So, in this fractional banking system, the fraction of reserves required to be held is determined by the central bank of the country or the particular territory in which the bank operates. And it's known as the reserve requirement. So this system exists because it allows banks to basically loan out more money than they actually have, thereby creating new money and expanding the money supply, which the thinking is this will stimulate the economic growth, right? It also helps banks to meet their demand for loans from borrowers, which can lead to increased economic activity. However, it also creates a level of financial risk, as it depends on customers not really withdrawing all of their deposits at the same time. So you guys would remember what we talked about a few days ago that happened in Lebanon. If you don't, you guys could always jump back to that video just from a couple days ago. Now, we've all grown up being taught the benefits of this particular banking system, the traditional banking system as we know it. So in a bid to kind of balance out the information, I've chosen today to talk about some of the disadvantages of this particular system, starting with bank runs, as we saw in Lebanon. What happens, as I just mentioned, is basically that if many customers simultaneously demand their deposits and the bank doesn't have enough reserves to meet all the demands, this could create a serious problem for the banks, which can lead to the failure of the bank and a loss in confidence in the overall banking system, circa 2008. Now, a next disadvantage is the potential financial instability. So the system can also lead to a cycle of boom and bust, which we've come to know, as banks may lend out too much money during good times and then not have enough reserves to cover their overall loans during the downturns. Sounding familiar? Yeah, the Lehman Brothers, etc., etc., etc. Also, a key disadvantage to this system is inflation. So the more money that banks create, the more money is put into the economic system, meaning that there's more money that is up for bid for the same amount of goods. So this increased money supply creates inflation, which we are seeing happening right now because we have, like I said, more money chasing the same amount of goods in the particular economy. Example, most of the US dollars in circulation right now were created in the last 3 years or so, right? Then we have the moral hazard, as banks are incentivized to take more and more risk because they know that basically the central bank will bail them out. It could create more and more difficulties for the financial system. So this leads to poor lending practices and increases the likelihood of banks failing. 2009 again, not too far. Now, one of the comparisons I always make here as people talk about Bitcoin and how Bitcoin is a failure, the fact is there's nobody coming to bail out Bitcoin. And while that sounds scary, it's why I think Bitcoin is ultimately building a more sound financial system. But anyway, I digress. The next thing I wanted to touch on is the social hazard. Now, banks, and by extension bankers, get to determine who gets this new money that they create. Now, what we've seen historically is that what comes out of that is the rich getting richer and the poor getting poorer, as access to credit is an important tool in basically scaling your economic condition. So this social hazard usually is hidden behind the terms like, business practices, risk management, etc. But I'm not trying to heavy up your Friday afternoon. I'm not trying to heavy up your weekend too much. So I'll leave it there for now. Guys, be safe this weekend and be safe as always. The crypto markets don't stop. Crime doesn't stop. Remember, adoption is inevitable. Illuminati out. Be blessed.
February 3rd of April, I don't know. It's going to be an alternate birthday bash. I want to let you be there with all the coolers, all the rum, all the beers. Don't forget to walk with all the ladies and all. Because you don't know things going to start off wetter than wetter. You don't know.